Hey everyone, welcome to another video. Today we're continuing on the series of how to become a better trader. This video is a little bit more advanced. We're going to simplify things as much as possible, but I do advise that you would have watched the previous videos like market structure, ranges, POI selection and refinement, strong levels, weak levels. I do recommend that you've watched all those videos or that you're somewhat advanced and you just need a little bit more tips on how to really just improve your own strategy, right? So that you stop taking losses and that you avoid getting into as many traps as you might currently be getting in. So please watch the other videos or else you're going to probably be a little bit confused on this one. This video is going to go in depth for the first half. I'm going to go over this cheat sheet that I developed. The link to this will be in the description. You can save it if you find it useful. Maybe it'll help you. Go ahead and save it and use this to better enhance your trading plan, your strategy. If you have any questions, you can leave me a comment and I'll respond. If you are wondering, I do have a Discord because a lot of people have requested that I start one. It's going to be linked in the description. I'm doing free coaching there. I have free cheat sheets just like this one from all my last videos. I do daily analysis and end of the day markups. I'm just trying to help people get better because I think that it's important to help each other. This is something that can be very overwhelming and there's not a lot of people that are willing to help you for free. So if you have questions, recommend you join there. Everyone's really nice in the community, so I'm not the only one in there. So let's get into this video. The second half of the video will be focused on the application and examples. So the first part, this is we're just going to go over the cheat sheet. I'm going to do my best to explain it, but I think that you will grasp it more as you read over it yourself later and that you really go in depth on back testing it yourself because that's how we learn, testing, patience and practice, right? So let's get into this video and let's get started, right? So first things first, we're going to look to the left side of the screen. We have 7 different sections we're going to go over, and you can skip ahead to the other sections if you already understand some of them, right? So section number 1 is about types of POIs. Anytime that we're looking at a leg of price, when we look to the left, which is a swing leg, right? What we want to see is where are our POIs, right? Typically the market's going to be trending. Sometimes it's ranging, right? But it's usually in some sort of continuation or some sort of pullback, and usually we are pushing into new territories. And so a good way to avoid falling into traps and a good way of getting the most optimal entry points in a price leg is to focus on extremes and decisional and the idea behind that, right? So extreme points, if we go ahead and read it, extremes are going to be the furthest point of supply and or demand in a leg, and they serve as the last point of defense before the reversal of a trend. Extremes are going to be the highest probability entry, meaning in terms of the highest likelihood of being successful without failing, right? When they do fail, it's typically because the market direction usually is going to reverse. In other cases, it can sweep you, but typically we don't see a lot of sweeping of extremes unless it's going to create a reversal of some kind. And we'll go over what it looks like with candles in the next section. The majority of price movements are going to be continuations. You usually will only have a reversal from, let's say, once we break structure, for example, we'll have a reversal when we are switching biases, right? And so most entries you'll find are going to be continuations, and that's why extremes can work very well. Now, we have a couple rules. Hopefully you understand what these rules are like and what I mean by them. If you don't, go ahead and ask me a question. I'll make more video in depth about these topics. Now, if you don't feel you get enough with the examples, watch some of my trade recaps. I have enough of those that I think you can learn from every single time frame, that whichever one you trade on. So go ahead and check those out. I really go into depth with those. Now, my rules for considering an extreme valid. Technically, the extreme is almost always valid. It should be valid, right? Just because it's the extreme. in a trending market, but doesn't mean that we likely will always come to the extreme, right? Some pairs are going to move more aggressively, and you'll notice that, for example, like, pound pairs, like GU, likes coming to the extremes. EU, typically doesn't. The decisional usually works really well, and flip zones usually work incredibly well, which we'll get into, right? But when it comes to extremes, they're valid just because they are the furthest point in a leg, and that's usually enough, right? But how do I decide to take them? Well, for me, to really focus on the extreme and ignore any other decisionals, it's going to be because the extreme must break something strong, right? And breaking something strong can be defined as either breaking strong structure or a strong supply and demand level, right? And whether you're bullish or bearish, that's just going to vary. For example, this example is going to be a bearish leg. You can see that this was a swing low to swing high. We break structure downside. This is the bullish. This was the high to the low. We make a new high, right? So for example, if the extreme is going to be the POI that I'm focusing on, it's because it must break something strong. So in this case, you see that this was a pullback that created a new high. The extreme broke that structure directly. This point resulted in a direct break of this strong structure. This could be a demand level, right? They created that new high, and it's also a swing low. So this is a break of structure. In this case, for example, same thing. We have this pullback makes a new low. This is a strong lower high, break structure to the downside. If the extreme directly breaks this point of structure, then to me the extreme broke something relevant that's strong. In this case, this could also be a supply that went, right? But it's also a point of structure, right? So it must break something. For me, the extreme has to break something in order for it to be valid. The other thing is it should create some sort of inefficient pricing, which, if you've already are, let's say, a little bit advanced on these type of topics, you'll understand that we'll leave behind some sort of imbalance. It's usually going to look like something like this, right? Or, a big gap between candle wicks and bodies. We'll see like a massive movement of price like this. Usually that leaves behind an imbalance of some kind, right? And what that tells me is that price moved very aggressively with a lot of volume and momentum that entered the market at the extreme, so much so that it left a mini gap in the market that needs to come back to be filled, right? The other thing is it should have some liquidity to take, whether that's structural liquidity, trendline liquidity, or relatively equal highs and lows. We're going to go over some examples of that in the application process, but these are the three things that I like to focus on. It must break relevant structure, right, or supply and demand levels. It should create inefficient pricing, and it should have some liquidity, whether that's any of these, to take before it comes back to mitigate that level, right? Now, in terms of simplifying it, how can we consider an extreme? This is something I learned from another video. This is, let's say, rally-based drop or drop-based rally. Think about it like this. We have a rally, we have a base, we paused, and then we drop. The extreme is going to be the base. In this example, in a bullish scenario, for example, we might have a drop, or obviously not necessarily a bullish scenario, but because in this case we're switching to the upside, right? So we have a drop, this is the base, this is the reversal point, and then we rally to the upside. So that's how you can think about it. The base is going to be the extreme, right? And here you can see once again in this example, volume and momentum entered. That broke this point of structure that was considered strong. Now let's get into the decisional. So decisional points can be referred to or defined as the point where price decided to commit to a direction through an injection of volume and momentum. Decisional points are typically found just under in terms of a bearish scenario, or just above in terms of a bullish scenario of the extreme. Excuse me for that. So in this case, for example, of this bearish scenario, we're making new progress to the downside, we're breaking structure downside. Here you can kind of see that this extreme failed to break anything relevant. In this case, you saw that the extreme had enough power to directly break this point of structure. But here you can see the price pushed down, we had a pause, price pulled back a little bit, and this was the area where volume and momentum entered the market and broke structure downside. So this first strong point of structure, this first strong low, went with the decisional when that's where we got that volume and momentum injected. This would be a bullish scenario. So here you can see the extreme failed to break any relevant structure. Price pushed up. We had a little pause and a pull back. And this is where volume and momentum were injected into the market. And you can see an explosion of price that results in a break of structure, of a strong point of structure, right? In this case, decisional points are more likely to be respected when the extreme fails to break anything relevant. And so this is how you should be looking at it. Whenever you're looking at a swing point or a swing leg, for example, we have a low to a high, or for example, if we have a high to a low, whatever we're looking at, what you want to be focusing on is going to be which is the one that broke relevant structure. Did the extreme do anything or not? If the extreme didn't do anything, likely the decisional is going to be the area that actually did something. Let me copy this one. Can I do that? I can't do that. I forgot. I guess I should add it here so that you can see it too. Let's do that. One more here. That way you can kind of see those points. Now, the rules. There's a couple more rules for the decisional points, and you'll understand why in the application of this. The rules. The decisional must break something strong, whether it's structure or supply and demand levels. That's the same rule as the first one. The other thing, in my case, this one I think is very important. 90% of the time, this will save you from a lot of mistakes. If you leave it as a must, you'll have much better success rate than if you leave it as a should. So the second one is must create some interaction between buyers and sellers. And this example is going to be a flip. I'm going to show you that if you look to the right side of the chart, this is what it's going to be. But for right now, all you have to know is some sort of interaction between buyers and sellers. Ideally, it will be a flip. That's the only type of decisional that I like to take consistently because that is going to really increase the probability of success on those POIs. The other thing is it should be well priced, premium in bearish scenario, and discount in bullish scenario. That we will go over in section 4 all the way to the right here, right? But it should be well priced. The extreme is always going to be well priced because it's going to be the last point before reversal occurs. And so an extreme is always going to be well priced in a swing leg, right? Now, for decisional, you only want to consider it if it's going to be in well-priced territory. So the other thing is it should create inefficient pricing and leave behind imbalance. Same thing as, extremes. It should create enough of a gap in the market due to its massive volume injection. Something like this where you see a massive candle to the downside that engulfs pretty much price. Now it can look in different examples. You can see a massive wick that sweeps structure, same kind of thing, but as a result of that sweep or as a result of a trigger, you should see an engulfing candle to the downside that is basically creating an inefficiency, right? The other thing is we should have some liquidity to take, structural liquidity, trendline liquidity, or relatively equal highs or lows. That's going to make the likelihood of probability of success much higher. So these are the rules that I think you should consider. Now, in terms of decisional, how can we think about it in a simple way? Decisional is going to be this little point here in these examples. So instead of thinking about it like a extreme, which is rally-based drop, which is a reversal, or a drop-based rally, another reversal, this isn't going to be reversal. This is going to be a continuation, right? So in this case, you can think about it as a drop, a base, where we pause, and then another drop. It's a continuation point, right? In the case of, let's say this example in the bullish scenario, We can say rally, base, pause in the market, rally, right? That's a continuation model is kind of what we're looking for. So hopefully this makes sense. The idea behind this is we're going to focus on these two types of POIs. Now how they look like, let's get into that with section 2. Section 2 is candle bodies and wicks. Now these are not going to be absolute perfect examples. There are going to be dozens of variations of this. In fact, the way that these look exactly like this, it's not going to be like this all the time. Now you will find them, but you're more likely to find some sort of variation of this. So don't be married to the idea of what it looks like. The idea of what I'm trying to explain of what the principles behind it, right? And so let's get into that aspect of this. So a little thing here, the most profitable traders understand that consistency and simplicity are the keys to success. These refinements are back-tested, proven, and highly profitable. These candle formations will be found in extremes and valid decisional points. Each of these must meet the rules discussed in the previous section. So once you've taken a look at a swing leg, right, and you've determined, well, which point of interest could be the one that makes sense, right? Which one, for example, broke something relevant? Which one did it have an interaction? Did it leave behind inefficient pricing? Is there some liquidity to take before we come back to that POI? Those are important questions to ask yourself. Now the question is, when you look at that area or you refine it down, what are you looking at? These are candle bodies and wicks. So when we're looking at, these are the types of setups that I like to look for. These are the ones where I will always find a really good POI, as long as it meets the rules to the left and it'll meet the rules, before entering on the right. This is what they should look like. In a bullish to bearish scenario, so this is going to be like a reversal of some kind. Price was going bullish and then it went bearish. So in that case, what I'm looking in this example is a buy to sell engulfing candle. This is basically a buy to sell candle that's engulfing. So in this case, you could see this in terms of a pivot. It could look like a range, but the idea behind this is an engulfing candle. We define an engulfing candle as something that eats basically an entire candle with its wick and everything. So for example here, let's say this candle basically engulfed two candles. We have one entire candle body and wick. We have from this wick to this wick. So this entire candle was eaten by this sell candle and it left behind inefficient pricing. In a bearish to bullish scenario, we'll look for a sell to buy engulfing candle, right? And that's what this would look like. You'll see that this is an explosion, a very aggressive explosion to the upside that basically is almost full-bodied here. You can see that there's little to no wick on this type of candle, and it eats away one entire candle or several candles, for example. So the open and close of this candle is greater than from the wick to the wick of this candle and the wick from here to the close of this candle. That's very important. In this case, how do I like to take entries when I see these candles? Now obviously in my case, I'm refining down these candles. A little tip, I like to take buy to sell engulfing candles at the 25%. I'm going to give you more examples in the setting orders option, but in this case, the idea behind that, I like to set most of my trades at 25% mitigation. So if I take the low to the high of the candle that gets engulfed, this is the candle prior. So all the injection of momentum and volume entered somewhere in here. Because as price opened here and it pushed down, it pushed high, it came back closed here, and then we had an injection of momentum somewhere right in here that basically when this new candle opened, it pushed to the downside so aggressively and it closed below here, right? It engulfed those two candles. So for me, I will take the candle prior to the engulfing candle and I will set my entry at the 25% with my stop just a little bit above or at the equal high, which would be the 100%. So for example, obviously, I'm going to give you live examples of that, but let's say this is what it would look like. So I would enter at the 25%, my stop would be at the 100, and then obviously I would set my target at a relevant point below, and when price comes back to mitigate, I will be triggered in when price comes into the 25%. Same thing for here. This is what price looks like. It's moving down, up, comes down here, taps into something, triggers enough momentum and volume to explode to the upside. In this case, I will enter at the 25% from this high to this low, stop loss just below the low. Another thing that we can look at is candles that take liquidity, which in this case can look like two variations. There's a lot of different, let's say, versions of this, but two main ideas. You'll probably have heard of this, a sponsored candle. Some people will call them FU candles. I don't really like that, but maybe you'll know by that term. In this case, a sponsored candle is going to be a full-bodied engulfing candle that takes liquidity. So the same way that this one is an engulfing candle and it breaks structure like this, and it leaves behind imbalance, the difference between this one and these is that this one has an immediate reversal of price. So when we see a sponsored candle, it's a full-bodied candle closure with little to no wick. You'll almost never see wicks on these, or maybe the smallest wick. If you see a big wick on this, then it's not a sponsored candle. But the idea behind this is it's going to, in this case, a bullish to bearish scenario. So our price was moving higher. Here we created some equal highs, some liquidity. Price exploded to the upside. Full-bodied candle closure up here. Swept all this liquidity and an immediate reversal. And typically what you'd want to see is that the pullback, the reversal candle, engulfs the initial sponsored candle that took liquidity. So in this case, when you have it engulfing to the buy side, you might be considering taking a long, thinking that, hey, this price just massively exploded to the upside. Maybe now we've broken out. Usually what happens is we'll take stop orders or we'll trigger some resting orders. And once we trigger them and we sweep the liquidity, we tap into that resting liquidity, we usually trigger them, and now we've created a reversal full of volume. And that's why we usually have the second candle is also going to be full-bodied candle closure engulfing, right? And in this case, when we have a bearish to bullish scenario, we might have resting orders just below here. And so what we'll see is price will come in, it will full-bodied candle close engulf to the downside. It's going to sweep liquidity, trigger some resting liquidity, and an immediate reversal with little to no wick will have a reversal that engulfs the first candle that engulfed, right? So this one will make you think that we're going short, but we'll usually follow that by an immediate reversal that engulfs the initial sweep, right? And so on these type of candles, what I'll do is I'll take the 50% of the initial sponsored candle, the one that got engulfed as well and that engulfed the sweep. So for example here, this candle engulfed the structure to the left, these candles here, the range to the left, and it also was a full-bodied candle closure. And when I saw this aggressive reversal, I can guarantee that there's a lot of resting liquidity within the sponsored candle. So in this case, on a bullish to bearish scenario, I will set my entry at the 50% mitigation. So I will wait for price to come back to mitigate the 50% of the sponsored candle before I get inside my entry for a continuation. Not only is that going to help me narrow my stop loss, but it's also going to increase the probability and the risk to reward ratio of that specific trade. And so for me, that's going to be a lot better. So entry at the 50%, and that's highly probable, right? Same thing for this one, entry at the 50%. In this case, stop loss will be just below this level. In a bearish to bullish scenario, my stop loss will be just below here because this candle was engulfed to the upside. And so when I'm expecting price to pull back, I don't want it to violate this low. This is protected. And so it should come back to the 50 and continue. Now, while this candle took liquidity, right, a variation of this type of candle would be a wick, a sweep. These are going to be very aggressive. The idea behind this, and I call them liquidity points of interest, liquidity POIs. You've probably heard that before from somebody else. The idea behind this, kind of the same thing. You see here that we might be, building some liquidity. We might be ranging. We might have some sort of pivot. But the idea behind this is that price very aggressively sweeps liquidity. And in this case, this is a, let's say, a bearish to bullish scenario. But this one was, let's make sure I actually correct that. Bearish to bullish. Sorry about that. Should have fixed that before the video, but I did not notice that. So this would be a bearish to bullish scenario. How do I unlock that thing here? There we go. So the idea behind this one is that we have prices pushing to the upside here. Price immediately sweeps liquidity to the downside. Here we've tapped into something, so we've liquidated these orders, but we've tapped into something to the left that has triggered let's say a lot of buy orders, and that increase of buy orders was so aggressive that we have buy orders stacking and eating up what would have been the candle closure, the candle body closure there. And what you'll see is that we leave behind a very long and aggressive wick. Usually the bodies to these candles are going to be very small. And typically what that means is we had enough stacking of buy orders here that caused a reversal and pushed price to the upside. So this was bearish, we sweep liquidity, and then that triggers enough orders to push price higher, and now we switched from bearish to bullish, right? In this case, same thing, but now this is going to be a bullish to bearish scenario. Let me just clean that up a little bit. So here, same thing, liquidity point of interest. Here we are going from bullish to bearish. So you can see price is building some liquidity here. You can see a very aggressive sweep that this creates a liquidation of orders to the left of a couple of points of interest. And then what we see usually here is that we mitigate something to the left that triggers enough resting orders. And you can see that we are stacking sell orders. So much that sellers are basically purchasing this entire area that would have been a candle body, and they're pushing so much with so much aggression that you usually will see such a small body with such a long wick. And immediately to that, you'll see a reversal of price. So this was bullish to bearish, right? Same thing as the sponsored candles. I like to take the 50% of this. Now, there'll be different ways. You'll see in some of my trade recaps, I might enter off of a 50% of the wick only. And while that might work for my rules sometimes, and you'll want to test for yourself and maybe refine it, I do recommend that, the safe way to get triggered in will be take the entire candle into account. Usually the body's pretty small anyway. But so for example, in a bearish to bullish scenario, price is pushing to the upside. This was a reversal point. So I'm expecting price to come back to mitigate at least the 50% of that candle. Sometimes it comes to 50% of the wick, which would allow you to narrow it down just a little bit, right? But at the same time, safe place would be 50% of that candle. And that's a high probability mitigation. Same thing with here, bullish to bearish scenario. We swept, and then we pushed to the downside, break of structure. This, of course, all of these examples must meet the rules in step 1, right? Where they must break something relevant, they should create inefficient pricing and leave behind imbalance, and they should have some sort of liquidity to sweep before we come back to the POI. All of these things have to be met before we for sure set a limit on these places, right? But the idea behind this one is bullish to bearish scenario. I'll set my entry at the 50% of this wick with my stop loss just above this area to protect it, because likely price will come back to mitigate this 50% of this area. And so in many cases, when you'll see these two examples, they're going to be sweeps of liquidity, and that's why usually price will come back to the 50% level of anything that sweeps, especially if it was an aggressive sweep that really, let's say if you have a very long wick or a very big sponsored candle, usually you're very likely to get that 50% mitigation, right? In this case, when we see like a buy to sell engulfing or sell to buy engulfing, a 25% mitigation or a open at open will be very likely. Here I gave you the option, you can pick the 25% or the 50%. Both of those likely to get hit. 25% will be more likely to be hit. In my case, this is what I use, 25% for these. So Of course, remember, before you consider the candle, the area must meet one of these rules. It must be an extreme or it must be a decisional that's valid, right? And then this is what you're looking to refine down to. It should look like some of these. Now there's variations of this and you're going to notice that in the applications, but it should look like that, right? Now, the idea behind this is that's what your POI should look like. Now, the way that I trade is I like to take confirmation style entries. I'm not very much about risk entries. This video will go over both because they're both going to show a lot of valid opportunities. But usually, and this area works more or is more important for confirmation style entries, meaning let's say for example if I have a 4-hour point of interest, which on part 7 we're going to go over, when I'm refining down, so if my POI is a 4-hour point of interest, I await for a price to come into the 4-hour POI, and then I'll drop down to my execution time frame. Let's just say it's the 15-minute time frame. Once I see price coming into it's in the 4-hour, I'll drop to the 15-minute, and I will await for a change of character and a flip before I enter. If there's no flip, then I might look for a better kind of opportunity, or I might be a little more patient and just wait to see what happens, right? We're going to cover those. But why are these relevant? These are covered in the market structure video and cheat sheet, so review those if you haven't, that video if you haven't. Flips are going to present themselves in decisional zones. Usually the extreme failed to break anything relevant, and therefore the decisional is where a battle, which can be referred to as an interaction, between buyers and sellers occurred. Flips are an example of rule number 2, right? Like this area, for example, rule number 2, which would be must create some sort of interaction between buyers and sellers. Example flip. So that's rule number 2, right? If the flip, however it appears, candle body and wick examples, right, could look like any of these a flip, right? If flips are an example of rule number 2, the flip, however it appears, candle body and wicks examples, if it takes no liquidity, meaning it doesn't sweep, then it likely will be swept, and entry here is likely to fail. If the flip does take liquidity in terms of a sweep, then it likely is to be a good entry if all rules and decisions are met. So what does this mean? We ideally are looking for something that sweeps some sort of liquidity. And therefore, from these wicks, candle bodies and wick examples, typically a flip should look like something like this. It should be a mini sponsored candle, or it should be a smaller liquidity point of interest. It basically just has to sweep liquidity before it breaks structure. Sweep liquidity, break structure. Sweep liquidity, break structure, right? So here's some examples. Change of character, you should already know that from my market structure video. We're not really going too much in depth on that. But here you can see in this chance, like let's say we've refined our point of interest. So let's just say that this was a 4-hour, let's say POI here. This was a supply, price came in. We're now within this 15-minute time frame. And so what do I see? I have one break of structure to the upside on my execution time frame. I can see price is pulling back down, maybe building some liquidity. And then when price taps into this demand, do I get a reaction? Let's say in this case, maybe I get some reaction, some sort of interaction between buyers and sellers, but no sweep. And then once this area breaks structure to the downside, we get our change of character because we've had our first strong point taken. So this was a strong demand that broke structure to the upside, right? This demand broke structure to the upside. This is a point, right, in market structure, but it's also a demand. And so what I'm doing is I'm awaiting price to come into this demand, and I'm looking for a reaction. If I don't get any reaction, what that tells me is there really was no strong interaction between buyers and sellers, and I'm likely not going to trade off of that area. How I would like to see it would be like this. So we break structure to the upside. This is a strong low, makes a new high, makes this a strong demand zone, and this is a strong point of market structure, strong swing low. You can see the price is pulling back into the POI, and is what? It is building liquidity. You see price comes in to tap the demand, right? It's respecting the swing low. We basically get a reaction that forms an extreme. That extreme sweeps liquidity to the left. In this case, it's what? Structural liquidity, internal structural liquidity. It could be trend line liquidity, right? It could be, relatively equal highs and lows. But the idea is that the reaction resulted in a sweep of structure. That sweep could look like this, or like this, or like this, or like this, right? And then what that means is when price breaks structure to the downside, usually what you can expect is price when it comes back to that area. Let me change this because this is a little too dark. Here we go. Let me do that drawing here again. When price comes back to mitigate that area, for example, it will come back into that, mitigate it, and will bring a very aggressive reaction as a result of that. Because that's a liquidity point of interest. It swept liquidity, right? It swept liquidity, tapped resting orders, and enough resting orders that broke structure and broke this initial demand, right? Remember, market structure video is going to have more info on change of character and flips, so watch that first, right? This would be a bullish to bearish scenario, reversals, right? In this case, let's say we're coming into a 4-hour point of interest demand zone, right? And so I drop down to the 15-minute time frame execution because I see that we are inside of a 4-hour point of interest. Now I'm awaiting for a change of character and a flip. This is a bearish to bullish reversal scenario. Price comes down, we have this low, pulls back. This point breaks structure to the downside, we make a new low. This is now a strong supply. It's also a strong point of structure. So now what happens is price is pulling back up. We might tap. If we get no reaction and we just violate it, we just break it, then we have no flip, but we do have a change of character, right? This is reversing because it broke the first strong point. If price gives a reaction but it doesn't sweep liquidity, then likely it's not going to really fit our plan because it's not high probability enough, right? Now here's what we would like it to see, what it looks like, right? So we have a break of structure. This is a strong supply and a strong point. Price is pulling back. We tap into supply. We create a reaction that forms an extreme that sweeps liquidity, whether that's structural, trend line, or equal highs or lows, whatever. It takes liquidity, and then it violates and breaks that strong point of interest that created the initial reaction. So the initial reaction is broken. And so what we can expect now is when price comes back to our POI, it'll tap it, and then we'll get a very aggressive reaction from it in continuation. And this, once again, should look like these examples. It could look like this, but realistically, if it sweeps liquidity, right, it's going to look something like this. It's either going to be a big wick, or it's going to be a sponsored candle that sweeps liquidity. That's what we would like to see. We would like to see a change of character and a flip for us to get our entries, especially when we're considering confirmation entries, right, inside of a refined point of interest, right? Now let's move on to part 4. Now if you haven't seen the POI selection refinement video, watch that one first. This is going to be about premium versus discount pricing. One of the rules, as you remember, is that the POI should be well priced. And when it comes into a bearish scenario, let's say up here, right, this is bearish trending market, we should get, for example, premium pricing is what we're looking for. When we are in a bullish trending scenario, we're looking for discount pricing. So one way to think about it is just always remember that premium pricing is going to be above and discount pricing is going to be below, right? That should be a simple way. Now, let's go over this. So any POI in consideration must be well priced within the most recent swing leg. You can choose to consider the 50% shift from premium to discount, or the 30% and the 70%. For highest probability POIs when trading pro trend, select POIs that are well priced. So are we always going to have price come back to premium pricing or discount pricing? No. Are all the POIs that we react to going to be in premium or discount pricing? No. Sometimes we'll have price, and that's what the ranging markets video is all about. But a lot of times you'll have price react to something pretty low in the leg, and you'll get a break of structure. And while that might seem promising, likely that in the near future, that point of interest is going to be taken, and we will come back to the extreme or decisional points within well-priced territory, right? The POIs in well-priced territory. So keep in mind, be patient for your points of interest. Don't get into price just anywhere, and this is going to help you. So for example, if we are bearish trending from this is a swing low. So this, bearish trending, we're expecting new lows. So we have what? A lower high, lower low, lower high, lower low. And so for this to work, what you want to take is the most recent swing leg. And once you see prices pulling back, you only want to focus on point of interests that are in this premium priced territory. In this case, above the 50%. Price will come back to that POI. And as long as it's above 50%, you will increase your likelihood of it being valid. More often than not, if you take trades from the low part of this low swing leg, or let's say the high part of the swing leg, you're simply going to be swept many times over. I go over that in the simplified trading video that's about strong and weak levels. Now, discount pricing, same thing. We have expecting new highs. We have a higher high, a higher low, higher high. So you want to take the swing leg, the most recent swing leg that broke structure, and the thought process is that the pullback is going to come back into discount pricing. Now, you can choose to use between either the 50% mark as the premium and discount pricing shift, or you can just use, let's say, the 70% and the 30%. That means that 70 to 100% is going to be premium, and then 30% to 0 is going to be discount pricing. So when you're bearish trending, you want price to come back into the premium, which is at 70 or above POIs, or in a bullish trending market, you want price to come back to a 30% or below discount pricing pullback, right? That's going to save you a lot of traps. You're going to really filter your POIs, and you're going to stop getting distracted with levels that simply are not valid, right? All right, so by now, you should have a good understanding of how to prevent yourself getting into traps and preventing a lot of the losses that come into trading, right? You want to focus on areas that are either extremes or decisionals. First, you want to define them. You want to say, okay, is the extreme the most valid POI? If the extreme didn't do anything, then likely your point of interest is going to be a decisional point, right? If the extreme did break structure, something relevant, then that means that the extreme is likely going to be your highest probability POI. You want to get in where volume and momentum entered the market. And you know it did when it breaks something relevant, creates inefficient pricing, right? You want to make sure that it's well priced and that there's some liquidity to take upon returning to the mitigation point, right? Now, once you know your valid points of interest because they meet all those rules, what you're trying to do is you're trying to refine down as much as possible so that you can get a candle that looks clean, whether that's going to be a buy to sell engulfing, right? Or a sponsored candle, or a liquidity POI, a sell to buy engulfing, whatever. These are going to be 3 basic things that you're looking for, and there's going to be 100 different ways that they can look like, because there's always going to be variations. But the principle behind it, this is what you're looking for. So now, if you have a valid extreme or a valid decisional, and now you've refined it down to something that looks like this and it meets all those rules, you are going to set your entries. For example, if you're going to set a risk entry, or let's just say this is your refined entry because now you've seen prices tapped your POI, you've dropped down to your execution time frame, you have a change of character and a flip. Your flip looks like one of these, and you can either choose to set your limit on, based on my suggestions or your own, right? I'm going to go over now why it's important to understand where you should set your orders. Now, do whatever you want, right? This is important for you to build your own strategy and not just copy everybody else. I'm going to explain why I'm going over these levels, right? So think about it like this. When it comes to setting your orders, let's just say we set a buy or sell from the open. So this is the example. This is going to be a buy to sell engulfing, or I have these candles mixed up. I guess the colors are a little off. I should fix that. But let's just say, for example, that this is engulfing candle to the downside. This is an engulfing candle to the upside. So if we buy to sell from the open, we're going to get the most entries and we're going to get good risk to reward. If we buy or sell from the 25% mitigation level, we are going to get more entries, which is less than the open. Oftentimes you're going to see that 25% is a very safe, happy medium between the open and the 50. You will miss entries at the 25%. But the difference is you're going to have better risk to reward when you do get triggered in, right? Now, when you go to the buy to sell from the 50%, right, whatever type of trading plan that you have, whether maybe you're only focusing on liquidity, point of interest, and sponsored candles, I don't know, right? But if you enter from the 50%, because it's also valid for any other candle, right, you're going to get the least entries. You might be missed by even like, you know, it might come to the 40%, the 45%, maybe spread even misses you. You will get entered into trades, and, you know, very often you will, but you're going to get less entries than if you set your orders at open or 25%. But you are going to have the best risk to reward when it's successful. Now, that doesn't sound very simple, right? So let me give you some numbers here, right? I'm going to try to put it as simple as possible. Let's go into this scenario. What fits your trading plan? Let's just say you have $1,000 and you're risking 2% per trade, which that's what I like to do. I risk 2% per trade for my personal funds. So let's just say if you set your trade at the open entry, you have a 10 pip stop loss and a 100% take profit. That sounds great, right? You have a 10R trade. At 2% risk per trade, you're risking $20. And $20 with 10R will turn into $200 of profit, right? Which is 20% of your entire account with one trade. Sounds amazing, right? Now, you know, what if we do the 25% entry? Let's say the 25% entry gives you a 7.5 pip stop loss, right? And a 100 take profit, same take profit. Now that 10R becomes 13.33R. It doesn't sound like much improvement, but now that $20 risk turned into $266, right? Or 26.6% profit. That's 6% more profit from the same trade, right? And now, let's say you missed that trade. Maybe you just didn't take any profit and you just sat out of that point of that potential winning trade. That can happen, right? Let's just say you set your trade at the 50%. You got a great sponsored candle and you know that no matter what, the highest probability is it will come to the 50%. And so now that 10 pip stop loss becomes 5 pips. And you have a 100 point take profit. Now a 10R trade or a 13R trade, it turns into a 20R trade. So $20 of risk now earns you $400. And that means that you made 40% of your account with one trade. So the question is it better for you to take more trades or better priced trades? And I'm going to leave it at that. You need to decide for yourself what you're looking for. You are going to miss trades if you refine your stop loss, right? You're also going to get taken out of trades if you don't account for spread in your stop loss. You absolutely will, right? And so you got to think about that. Maybe what you even say is, look, I'm going to get in at the 25%, but I'm going to extend my stop loss by the extra 25%. So it's kind of like you don't narrow your risk, but now you're giving yourself more room, let's say, because you might have a bigger spread. Actually, I like to do that sometimes. So in my case, if I have a 2 pip stop loss on a small candle, I might go and entry at the 50% and just put a 1 pip stop loss above the high. And so now, I'm covering that extra area in case I get swept or the point of interest gets tapped to the extreme, whatever happens. And a lot of times, guess what? I'm still in that trade. And maybe I didn't narrow my risk down, but you can't always focus on being greedy and trying to get as much as possible, because you will miss out on opportunities and you'll be taken out. So you have to decide what makes more sense to you. I prefer 25% entries most of the time. The way that I'm showing you my suggestions, my tip, that's exactly how I take these scenarios. I'll take a 50% off of these two. I'll take a 25% on this, right? In some cases, it might change, but in most cases, that's what I'm looking for, right? So you decide that. Now, refinement before entry. At this point, you've already figured out, is it a valid extreme or valid decisional? What does it look like when we refine it? It looks like one of these. Where am I entering from, right? Am I getting in at an entry based on a risk entry of that point of interest, or am I dropping down to my execution time frame that's lower than the point of interest time frame? And am I awaiting a change of character and flip to give me my entry? I already understand premium discount pricing before I select my POIs, right? You already understand where you're setting your order from. And at this point, now you have to focus on the refinement before entry and understanding what's happening and what you're looking for, right? So one thing to keep in mind is before entering any trade, identify first, is price bullish or is it bearish, right? Are we expecting continuation or pullback? Did we just break structure? Then likely we are going to have a pullback, right? Did we just complete a pullback? Do we look like we are respecting a point of interest that's a decisional flip or an extreme? Then likely we can expect continuation, right? What is the most recent swing that broke structure? This is how I mark my swing points. I have these dots here, right? And so that's important, just so that you keep in mind, what is the most recent swing that broke structure? Do we have a valid extreme or decisional POI, which is in section 1? Are the POIs well priced in premium or discount territory, section 4? And how far are we able to refine our POI? From the 4-hour point of interest, we should be able to refine down to the 15-minute. Can we refine a 15-minute to the 1 minute? Can we refine the 1 minute to the 5-second, right? So those are all questions you should ask yourself before entering. You should have that kind of understanding. Now, the next thing is, when do you enter, right? I've already shown you how to select your point of interest. I've already shown you what the entry should look like, how to enter it, when to enter it. At this point, this is what the type of setup you're looking for. These are the rules that must be met. When do you enter? Now, when you're on your execution time frame. Now, if you are entering with risk entries at higher time frame point of interests, this doesn't apply to you. But my strategy is reaction-based trading. So if I have a 15-minute POI, I'm going to wait for price to come into that 15-minute. I'm going to drop to my execution time frame, which is a 1 minute or the seconds time frame, whatever I'm focusing on. And then what I'm going to do is I'm waiting for these things to happen on my execution time frame. This is the most important thing. When the execution time frame shows this, it doesn't matter what happens on the higher time frames. Your execution time frame must show a liquidation, which is some sort of sweep of liquidity, right? It must show a mitigation or a respect of a POI, right? That respect of the POI should even be on your execution time frame. You want to see an aggressive reaction as a result of a sweep and a mitigation, right? It's sweeping one point, it's mitigating something to the left, and that reaction to the mitigation should be very aggressive, meaning that it probably results in a change of character. It pushes price down very aggressively or pushes price up very aggressively. We get a change of character, and likely we get some sort of flip, right? That's what we want to see. And so what time frames are you doing this on? If you have a 4-hour point of interest, you are going to await for a 15-minute change of character inside your 4-hour point of interest. And you're going to enter at the 15-minute extreme or flip, right? This is how you do your confirmation entry, right? 4-hour point of interest, price comes in. Once you're inside, you change to the 15-minute. You wait for a 15-minute change of character. It's going to look like this, right? And you look for a 15-minute extreme or flip. Whichever one, that's going to be your place of entry. And remember, now that area has to what? Meet these rules. Has to break something relevant, has to leave behind inefficient pricing, has to have some liquidity to take, right? You are now doing this all over on that execution time frame. Now, if let's say you have a 4-hour POI that you've refined down to the 15-minute, now this is how you do it. You have a 15-minute point of interest. Now when price comes into that area, you await a 1-minute change of character inside the 15-minute point of interest, and you're going to enter at a 1-minute extreme or flip. Now you're in the 15-minute. This is what the 1 minute should look like as you drop down. You should see a change of character, right? And you should see some sort of flip. And you're going to decide to enter at the extreme or the decisional, which is going to be a flip that swept liquidity. Hopefully that makes sense. That's all of part 1. I know we're 1 hour into this video, so I really don't want to take up too much of your time. So we're going to go quickly, but we're going to really go over the examples here. Now remember that the chart is going to be available in the description link, right? So that's important. Just keep that in mind. The charts that we have all the examples on is going to be up here. Let's go through all of these. So first thing, where's the first example? Here we are. All right, so first things first. We look at structure, right? In this case, we have swing structures. We have this high, we have this low. This is the extreme low that broke this high. In this case, technically, it's not a break of structure, it's a sweep. So we swept the high, right? And then we had a reversal. So we have this low to this high, right? And then when this low goes, which is the extreme, this one broke this high or swept the high, and therefore this is strong. When this high pulled back and broke this low with a candle body closure, which is in the strong or weak simplifying trading video, now we have what? We have this one's a break of structure downside. We have prices bearish because this is the most recent swing to the downside that broke structure. This is one massive leg, right? We also have here where we broke some structure here. So technically we could say that maybe we have some sort of extreme in here that broke structure downside, right? But when did we decide? We have some decisional points in here that we could also label. Now this is all back tested, so don't say that, oh yeah, you're marking these up just because you can see price. I know that these examples are for you guys, right? So now what we do is once we have our structure marked out, we know that we're currently bearish. I'll mark some POIs. So here I am on the daily time frame. Let's zoom in a little bit. So first thing that I'm going to do is I'm going to check out my pricing, premium, or discount. So I'm going to take my fib tool that marks the 50%. So I'm going to take the high, the swing high to the swing low. Now I'm only focused on anything above the 50%. In this video, we're going to go over 50% and 30-70%, right? So now anything above this 50% I'm focusing on. I can see a couple things. Remember, it has to be unmitigated. That is the key to this, right? So here I have this daily candle. So we have this is basically a doji candle, right? This area here that pushes price lower, and then we get another break of structure to the downside here. So here we got a break of structure. So this makes a low, it pulls back, makes this high, break structure downside. So this is a daily point of interest, not the cleanest, but it's an extreme to this swing from this high to this low. This is one internal swing, right? Internal swing here, this is the extreme. Now we have, obviously, this is one big swing here. Before we have this pullback, this is where we break this structure here. Technically, what this looks like to me is some sort of pivot. So we have a buy to sell that gets engulfed. And here you can see we leave behind inefficiency, right? So we have those 2 points of interest. Now what I'm going to do is I'm going to refine down to the lower time frame. Now obviously you can already see what this looks like, but we're gonna go to the 4 hour. So I have my daily points of interest. And this is for those who trade the higher time frames, right? Now what I'm trying to do is I'm trying to refine, can I narrow down a daily POI that in this case is 97 pips and like 80 pips. I'm trying to narrow these down as much as possible. So in this case, when I drop down to the 4 hour, look how clean this looks. So this looks kind of familiar. Look at this. What do we see here? This looks just like a liquidity point of interest. We even see a little sweep in here. So look, I'm going to mark this as a swing. This is how I use this little tool here. Sweep of liquidity with the little O. That looks just like this. Sweep of structure, or sweep of liquidity, and then we break structure downside. What are the rules? Right? We must break something relevant. Well, if we look to the left here, look at this point here. This is pretty relevant. Technically, this low made this new high, right? This low failed to make a new high because we just have a wick, right? This low didn't make a new high in here. Technically something in here did, but this area is more of a focal point here because this was the last pullback before we made this high and we ranged in price before we melted off. So here, this area broke something relevant, broke this structure, right? And it broke this structure in here too, right? So we have 2 points that we broke, right? On top of that, what do we have? Let's look at our little list. In this case, it must break structure. Did it have an interaction? Is it well priced? Right? We already know it's well priced because it's above the 50%, right? At the same time, we leave behind this massive inefficiency. Look at how big this gap is that we've created here, that we have this massive long body that's engulfing to the downside, that breaks structure. Do we have some sort of interaction? It looks like we do. Did I mark any of that out? I did not, so I'm going to mark that out here. We have this candle here. This is basically a demand zone. So this area broke structure to the upside, created a new high, so this is strong. Price came in, tapped, formed an extreme, swept liquidity, broke structure downside. Totally valid. Did price come back to that? It doesn't always have to. Crazy, huh? Right? Anyway, so this is very valid. Then price comes in here, pauses, pushes to the downside. Pauses, break structure downside. Here we have a pull back. Here we have another point of interest. This was a daily level. What did we do here? Same thing, we refined down. In this case, this swept internal liquidity in between these candles here. In this case, we swept what could be on a lower time frame, some sort of relatively equal highs here. Price swept and then melted to the downside and broke some structure. Same thing here. Did we break anything relevant? Yes. Because technically on this pullback, we have this high, this low, this high, this low, new high, right? We liquidated, we mitigated, right? We had an aggressive reaction to that area. We pulled down. What do we have? A change of character. We take some strong structure, right? Did we get a flip? It doesn't look like we did because, let's look at this. This was the demand. This was a sell to buy engulfing. 1 second. Sorry, I had to sneeze. We did not come back to tap this demand. We just ran straight through it. So this is the extreme that broke structure in this leg. And you can see because we formed a new leg. We have this high. Oops. We have this high to this low. We broke structure. So technically we have points of interest in here. You could, for example, grab another one of these and say, or is this going to be well priced? What's well priced? Anything above here, right? But we know in this case that the extreme did break structure. At the same time, I don't see any relevant decisional because this is the only area where we left behind some sort of imbalance or inefficiency. After that, Price was kind of very choppy on the downside. So to me, the extreme is valid. This is a 4-hour refined daily point of interest, right? Now let's look at the next step. We're going to go down to the 15-minute. So let me narrow this down here. So we're taking a 4-hour point of interest, and like I like to do, we're coming into the 4-hour point of interest. Let's see if we can refine that to a 15-minute before, so we can get an even cleaner entry, right? So we look back at this POI here, the 4-hour. What does it look like? We're looking for any of our candle body or wick examples. So we're looking for something like this, a buy to sell engulfing, because we're bullish to bearish, right? We're looking for a sponsored candle or a liquidity point of interest like this one, right? And so let's look back. Here, what do we have? This looks like we have what looks like tweezer tops. This looks like a liquidity point of interest, swept something in here, but it's basically a buy to sell engulfing with some wicks. So let's look for our 15-minute POI. Within our daily time frame, we have our 4-hour time frame. Within our 4-hour time frame, we would want to refine that to the 15-minute. We're not focusing on a 15-minute zone inside the daily, because the daily was already refined to a valid 4-hour point of interest. Therefore, anything outside the 4-hour point of interest isn't of interest to us at this moment. Now that we have this 15-minute refined zone, now we can get a much better entry. In fact, we can even set a limit off of that. Do we have anything here? Let's look to the right. I would, in this case, even say, maybe we could even set a limit off of this, enter at the 50% or the 25%. Let's see what we're going to look to the left. Let's look at our setup, right? So in this case, remember, this was a daily POI refined to the 4-hour, refined to the 15-minute. So the risk to reward should be very good, considering it's a daily point of interest, right? That was refined. Here we go. We can see price come in to this area. Let's look at some notes here to see what we saw. All right. So here we are. Price comes in, taps the point of interest, pulls back. It gives a reaction to the initial tap, but it doesn't change character. So this low is still strong. Here we can say this low created a new high, and therefore a change of character would have to take out this level. Then price pulls back, makes this low, comes up again, makes this a second tap, pulls back down, doesn't give a change of character. This low would have to go. This low then makes a new high, basically comes in to tap the top of this POI, right? Even maybe even it would sweep it on a different brokerage. Maybe it's swept, right? But technically now we have this strong low that broke structure to the upside, right? And so here, this is now a strong demand zone that we could be focusing on. So we want to see what happens as a result of this level, because price could tap, make another high, pull back, tap, make another high, and we could just get a continuation to the upside. We don't want to just take a short out of nowhere, right? We want some confirmation in this case. So price comes in, taps this demand to the top of it, right? We get some little reaction, nothing happens yet. Price comes back in, taps the same level, right? Equal lows here. Price pulls back. Doesn't really take any liquidity here. We're making equal highs. This looks like some liquidity that we could sweep. In fact, why would we be creating equal highs in a POI, that hasn't swept them yet? And then we break structure to the downside internally. Here we are on the 15-minute time frame, and we now have a change of character, right? Price came into tap, we got two reactions, but we don't have a flip and we don't have a sweep, right? So no sweep yet. So we're not considering an entry yet because we need a liquidation, a mitigation, right? Price comes down, pulls down. Now we've given a couple of change of characters because we've taken out some levels that were previously relevant, right? You can see these. Then what do we have? Price very aggressively comes back, sweeps liquidity. That's what we like to see. In fact, it sweeps these three levels, makes a new high, actually breaks out of the 15-minute POI. And the question would be, does that mean that it's not valid? No. We want to see what happens as a result of that action, right? So we have a liquidation. We have a mitigation of this level, right? Even a sweep, right? We have an aggressive reaction. Look at this. Here we can see that this low makes this high. This low makes this high. Technically, this is a strong low, right? This is a strong level. Could be considered strong demand. We could mark it out as a demand zone like this. We don't need to, but that's a strong low. This gives us a liquidation, a mitigation, a very aggressive reaction that gets what? A change of character, but we have no flip. Therefore, what do we have? We now have an extreme that broke structure that gave a change of character. Therefore, we're not looking for a flip, but we see what? A sponsored candle. Look at this. Here we have an engulfing candle, full-bodied, that took liquidity, right? Now in this case, the second candle doesn't engulf the first one. But what does happen? We break structure to the downside. And on a different time frame other than the 15-minute, it could very well show that this candle engulfed this candle, right? And so in my case, because we broke structure to the downside and we have three big candles that are basically showing a very strong shift bearish, we got that change of character. This is a sponsored candle to me. So the way I take them, right? I'll take from the low of the candle to the high of the candle, and I'll set an entry at the 50%. Here's my entry. We got triggered in at 50%. Now, what would it look like if we were entering the entire candle? So for example, if we counted, let's say, how big is this POI? This is a 10 pip POI. So if our target was 100 pips, 10R, right? But check this out. We narrowed down to 5. And now what would we have? If we had a 100 pip target, we'd have 20R. That's insane, right? Now here's the crazy thing about this. 5 pip stop loss. We are trading a daily point of interest. Therefore, we are targeting, and I'm going to define targeting in another video, a daily point of interest. So what should our take profit look like? Look at this. This was the low that failed to break this high. They created the pullback into this POI, and therefore this is my point of interest. And so when price goes and takes that level, we got to go back a little bit just to see it. Look at that. That was a 74R trade, right? Now it took a while, but look. 5 pip stop loss, 407 pip take profit, 100% valid, right? Took a while, required a lot of patience on whoever took this trade, 60 days, but 74R, clean, and it's totally valid. We're trading a higher time frame POI to lower time frame refinement. Now, of course, remember, let's just say you set your trade. Let's just say you set it at the 15-minute, and you just covered the high a little bit because you saw that this other wick was pretty aggressive. So let's just say you covered that high, just in case. 18 pip stop loss instead of 5. 400 pip target now. It's a 22R trade versus 74R. There's no reason not to refine your POIs. Let's be real here, right? Now, let's look at the second example. And this is going to be a continuation of this trade. So now let's go back on the 15-minute. First, I'm going to, where's the bar replay? I want to focus on this area here. So let's get down to the 15-minute. Same thing. All right. So let's hide that. So one thing that we have now, right? Once we have this area, what do we have? We have a break of structure. Technically, this low made a new high, right? So technically, this here is a 15-minute break of structure. 15-minute, bottom, broken. Think about it like this. As a result of tapping into a daily, refined 4-hour, refined 15-minute, we now break 15-minute structure to the downside after we take a high. So we take the high, we take the low, we should come back to mitigate something, right? So now I have another potential trade that I'm looking for. Now, what do I have? Setup number 2. Or structure here. There we go. So now what do we have? We have this high, to this low, right? We could say this low, price pulls back, comes down, pulls up. We have this low. This is where we get a good pullback, right? But remember, we only will take trades off of well-priced areas. This is no man's land right here. There's nothing in here, no POI. So here, I'm going to take, let's say, whether you choose to take that low or this low, let's just say for the sake of that one, we'll modify it to here. Doesn't make a difference, right? Anything above 50%. What are some POIs that we see? In fact, look, we have a flip, right? A clean flip. Now, obviously, if you got an entry up here, that was beautiful. But even if you missed that entry, you're always going to have opportunities for re-entry. Check this out. Now, these are our POIs. What do we have? Let me hide the previous stuff here. What am I doing here? Oh, let's hide this 15. There we go. And I guess we'll change that to break of structure. Okay, so now what do we have? Look at this. This area swept, created a demand, and this is the extreme that broke structure to the upside. So technically this is a swing structure, right? This low to this high. This is left. When price comes down, what do we have? It taps the demand, right, that created the high, gives a reaction. This sweeps liquidity somewhere in here, right? Internal liquidity, liquidates this, mitigates something to the left, right? We also have another sweep in here that's valid. But what happens here? This is a flip that breaks structure. So not only did we get a demand, we created reaction. So we didn't liquidate this area yet. We tapped it, formed an extreme to take some liquidity. We break structure to the downside, right? Leave behind some imbalance. Now we're building some liquidity in here, right? Look, high here, a little high here, trendline liquidity, right? We're building some corrective liquidity down here so that when price comes to our POI, maybe we have something to sweep. Now remember, we've already changed characters on the 15-minute, so we're bearish. We don't expect the extreme to get taken, and the extreme didn't break anything. None of these here broke anything down here relevant to that swing. They broke this change of character here, and that's why we got a 15-minute change of character up there, an entry at that extreme of this swing. But from this high to this low, this area is what broke structure, the flip. So our flips are POI. Here, we could just choose to set what? An entry at the 50%. Let's look at what we decided to do. Look at that. So we have liquidity on the downside, liquidity on the upside, liquidation, mitigation, right? In this case, we're setting a risk entry. Boom. We don't have to wait for change of character, flip, lower time frame confirmation. We're on the 15-minute. This is a decisional flip 15-minute. We're setting a limit because we're confident on that. In this case, instead of taking a 15 pip stop loss, we're entering at the 50% because what? This is a sweep, a liquidity POI. We swept, we're going to take the entire candle, right? Or you could just narrow your POI just to the wick, right? But then you'd want to enter at probably what? The open of it just to be safe. That's up to you how you decide to mark them. This is a variation, but it sweeps liquidity like this, kind of what happened. It's internal. What do? We get triggered in, and what's our target? Well, on the 15-minute, we have a target. On the 4-hour, we also have a target. In this case, same as the last trade. Let's go here. We can target the same low because this is just going to be a continuation of the first trade. This one reacted to the 15-minute. We broke structure, got confirmation. We re-entered on a pullback of this level, right? And look, this almost looks like sponsored candles. It's not, but it's pretty close. So this one swept a little bit, right? We got in this area. This is a pivot. This is the buy to sell engulfing to the downside. But in this case, on a lower time frame, we can see that it's a flip that broke structure, right? Very clean. We came into tap, targeting the same thing, 49R trade, right? Took some patience. Did it complete? Absolutely it did. Look at that. We'll drag this to the right. Never came back to take us out. Took profit, right? So that's example number 2. So hopefully you're kind of seeing that how this works, right? Here, and I'm just picking random places on the chart. Here we're going to look at this area here. So technically what we have here, which is one big swing, right? So we have this area here, break structure to the downside. The expectation is what we're still technically bearish until we take the high. And so in this case, we're now going to focus on this area of continuation, not on the one to the left yet. So this is our structure here. This is our swing. We have this high to this low, and we're pulling back into premium pricing territory, right? So we have this area. We're only focusing on well-priced territory. So I'm already, just by setting this up, I'm already eliminating me focusing on anything on the low part of the legs. This is at the 50%. You could choose it or not, but there's a lot of other POIs. I like to start from the top and make my way down if we're bearish, or from down to make my way up if we're bullish, right? I like to start with the extreme. So let's mark up the POIs. Now I did this in advance because obviously it would save a lot of time of me having to do this for you and then further labeling everything. So this is, once again, let's take a look with nothing. See if you can spot them. This is what they look like. Here we have on the 4 hour, right? This is a big swing. Anything above the 50%. This is the extreme. Unmitigated price did not come back to mitigate this area, right? So this is the extreme. Price comes down, right? Look, we have a pull back. This looks pretty cool, right? This looks like a decisional that breaks some structure here, right? But what do we have? No interaction. Price stopped. If we look to the left, there's nothing going on this time frame. Remember, it has to happen on the time frame of our analysis, right? No interaction here. This just paused in the middle of nothing. Therefore, this is not valid for me. I'm not considering this. So for me, I'm not paying attention to that. Price comes down, taps, forms an extreme, right? Pulls back, gets another reaction, sweeps liquidity here, right? Look at that. In fact, we get a sweep of the downside, sweep of the upside, and then we break structure, right? And so here, this, if I look at what this happened to the left, this is a 4-hour demand that broke structure to the upside. This was another 4-hour demand that broke structure to the upside. This was another 4-hour that broke structure to the upside. But this one's the only one that actually had some interaction and some break, right? Tap, formed an extreme, swept some liquidity. So here, let's label the area that got swept, sweep, right? What does that look like? Liquidity point of interest. How do we like to enter those? You can choose to make your own rules, but in my case, I'll like the 50%. So let's look at our setup here. In this case, for example, here, okay. So here, for example, what we can do is this too. So we have this sweep to the downside, sweep to the upside. So technically, we have a couple options. You could go here, and let's say if we use the 50%, let's see what happens. Here, equilibrium. Look at this. So close. Did we get tapped? Let's make sure that these are attached to the right level. So control. Yep. So here we got triggered in at the 50%. That's perfect. Now, if spread was not set properly, then you maybe even missed that trade, right? So in that case, maybe if you set at the 25%, you definitely would get triggered in. But even then, the 50% was tapped to a T, right? So how does our entry look like? Boom. We're going to refine this here because tap to 50. We're in. We have an 18 pip stop loss. Now, this is a risk entry. We're not refining down. So if you're doing a risk entry, there's no need to drop time frames. There's no need to get a change of character and flip inside of your POI, right? In this case, this is our POI because what? It was the flip. It broke structure, right? Price is bearish. So this is the area, the swept liquidity, liquidation, mitigation, aggressive reaction. We're looking for a mitigation of this level, right? Price comes back up, taps POI, pulls back aggressively, sweeps, gives us a change of character here. We pull back, come back in for another tap almost, but we do not tap the same level, so we just tap maybe the top of this almost. what are we setting our trade at? Or where's the swing structure? So we have the swing high to the swing low. Our target's going to be the swing low because we are expecting what? Based off our rules, where are we entering here? Are we expecting continuation or pullback? Continuation, right? And then, so continuation. So that means that the low must go. So our stop loss is just above the POI. Our take profit is just below the low. 15 our trade, 18 pip stop loss. Now, I'm not taking trades off the 4 hour with 15 pip stop loss or 18 pip stop losses. I'll trade the 1 minute and the seconds. But this is an example nonetheless that is valid, that makes sense, because a lot of people are not comfortable trading lower time frames. This is how you do it, right? Now, let's look at another example, because we can refine things, right? Let me show you the other option that we have here. Let's hide the entry in the setup. What do we also know that we have in here? Well, this low, pull back, this break structure the downside. So now let's drop time frames a little bit. Let's look like this. Go down to, did I label it? I think, let's see, the 1 hour structure maybe. Let's see here. It would be refined structure. What did I label that as? 15 minute. There we go. 15 minute. Okay, so we're gonna go to the 15-minute time frame. I have so many examples. Hopefully you're not exhausted by this and you just, hate me after this. But the idea behind this is obviously, the best way to learn is practicing, and this is one of the easiest ways to practice is me showing you examples and going over it with you till you understand it, right? So now we have this new swing, right? So here what do we have? Price was giving some corrective pullback. We sweep, we break structure downside. So now we have a new swing. We have the high to the low. Broke structure here, right? We can label it. That helps. Break the structure to the bottom. We're only focusing on POIs on the top half, right? So now what are we looking at? This is also the refined POI, but we can even refine down even further. So here we're on the 15-minute. What do we see? We have a valid extreme, right? Now here's the thing though, the extreme doesn't look like it actually broke anything. So this area pushed down, tapped, right, gave a reaction. Here we didn't really get a sweep, maybe somewhat. If we look on the lower time frame, right, here was the first time we reacted. We made this high, pulled back down here. Technically this one did sweep the candle just previous to that. It doesn't look so clean. It's not a beautiful POI, but it did sweep it, right? And then this came in to mitigate this level, aggressive reaction, pivot, and then we break structure, right? So we did get a change of character after that. Here's our change of character. Because that low made that new high. Once we take out this strong point of market structure, the strong low, we've shifted bearish. So now we have two POIs, right? We technically have a extreme that's somewhat valid. We have imbalance here too. It didn't really do anything, but because it's the extreme, it's valid, right? Then we also have this decisional that did somewhat sweep liquidity. Let's look to the right. Let's look for an entry here. Keep going, keep going. Here we go. So here, price came in to do what? Tap the 50%. So here's what our entry will look like. This is a 15-minute POI. So now we've refined the area. If we look at the difference between what we had earlier, here we entered at the 50%, which guess what looks, remember it got tapped exactly. The 50% of this entire candle here, the 4 hour, is also the 50% of a 15-minute, and both got triggered. The difference is that here we had an 18 pip stop loss, and here we have a 6-point stop loss. And that's the idea behind understanding that time is fractal, price is fractal. So understanding that price is fractal, you're going to see a lot more POIs that, when you refine it down, will, almost look kind of obvious, especially in backtesting. This is kind of funny, right? 50% of the 15 is also 50% of the 4 hour, right? So Here we turned a trade that was, what was the RR on this trade? This was a 15R trade that if we take a trade like this, targeting what? The 15 minute, this is where our first target would have been. So this is the extreme. This low made this high. Basically, this is weak as it failed to break this supply. Supply is now in control. The low should go. We're targeting the 4 hour. So let's go back here. This is the 4 hour low. And have we broken that already? We did. Look how clean that was. 15R trade to 44R simply by refining the POI. And it was so clean. Came to tap the 50% exactly. Right? Break structure, sweep, tap, 284 pips, 4 hour trade. Right? The 4 hour POI gave you 15R. A 15 minute refined POI inside the 4 hour is 44R. Pretty crazy. Now let's look at another example in here. So now let's hide those. Remember that you can play, there's multiple entries in every swing, right? And every swing has mini swings. So while we have this massive swing in here, we have swing structure from this high to this low, from this high to this low. And then from this low to this high to break, we have mini swings everywhere. So it's important to know what time frame you're on and how well and how deep you want to be refining your stuff to. So now let's go to this next setup. Was that it? That was one more. This one. Okay, so this is the new POI. Oh wow, so this was the same 15 minute I just gave the example on. So once we broke this, we shifted bearish. This was the first target, but now we have what? Another swing. This high to this low, we break structure. All right, now we're gonna focus on 30% to 70%, right? You can use the 50%, 30, 70, whatever you want. It's up to you. Back test it, see what you like, right? In this case, pretty big leg. I'm only gonna focus on the top 70 to 100%. So here we have a couple POIs. Obviously, we know what happened. Let's look at the POIs we marked out. These are on the 15 minute time frame. So why do we have these areas here? Well, this area here is basically a point that got engulfed, and we can actually refine these on the lower time frame, right? But we have three clear areas, right? This one's at the 70%, which is valid, right? Because if it was above 50, it'd still be valid, right? We have this area and this area. These two are very interesting. So this is an extreme. Here you have a wick, right? Didn't really sweep anything in here because we were still making highs. Maybe it swept something to the left. Could have swept some liquidity. But where did we get the true commitment from? Technically, we have what? This was the pullback. So this was the low that made this high. This extreme pushed down. We had a pause. We pushed down. This one very aggressively wicked through. But when did we get the break? Price kind of here hovered, ranged a little bit from this low to this high, and then engulfing to the downside. And this is kind of where we have a lot of continuation of a lot of sell candles. You know, eventually we come down and we break. Not very strong, but we know that the extreme did nothing. So to me, that's not valid. This decisional candle didn't really interact with anything. If you look at the low, it just paused in no man's land, no reason, right? This one didn't break structure, it caused a sweep. That sweep triggered some buy orders, pushed price up. And so here this was holding on pretty well. You can even say that technically this is technically a demand that's weak. When did that get broken? So demand, this went here. So this was the last candle that got engulfed that broke this low. So in this case, I want to actually drop down time frames a little bit. So let's see. We're going to go down to 10 minutes. Okay, maybe that looks more clean. Let's go to this 8 minute. Okay, doji candle, that looks more clean. Let's go down to the 5 minute. 5 minute here, I can even see this. Check this out. Here, look, we have, what does this look like? This is so interesting. We sweep the low, We trigger enough buy orders to push price higher. We leave behind a wick. And then this is a buy to sell, right? This doesn't get engulfed yet, but what does get engulfed is this area here. Let's see if we could refine that one down. This is what we have here. We have two areas. Oh look, actually on the 5 minute, this is more clean. I didn't even mark out the refined demand here. Here we have this. I hope you're not getting bored. You're probably super bored watching this video. But I hope you learn a lot after you finish this, right? So this demand pushed up. This is a weak demand in terms of it didn't break anything. This high didn't go. We pushed price down. We gave a reaction. The reaction did nothing. It just kind of ranged in here. Even if we drop down to like the even lower time frames, this is very just, we paused and then we broke structure downside. And so I can see in my notes here, this is not a valid flip. It did not sweep, so it will be swept. So that makes sense. So the POI, if we look just here a little bit above, look how clear this one is. So we pushed low. We had this candle that actually swept. So this wicked above, right? On the lower time frame, maybe even a 1 minute, maybe it looks even super clean, right? You can keep dropping time frames to find your POIs. Wow, look at that. That's beautiful, right? Price pushed up. This candle got engulfed, right? Candle body closed below the wick. We paused, pivot, buy to sell, engulfing to the downside. So from this low to this high, right? This is one push up, and then this push down broke structure. So this is where we broke structure to the downside. We tapped into this area. The demand was weak, did not give us a strong reaction. Price rolled over and then broke structure. So this is a very clean POI on the 1 minute. On the 5 minute, we can see that it doesn't look like a sweep, but on the 1 minute it is. Let's look at the setup on here. We're going to go all the way to the right. You could even enter on a 1 minute time frame with this trade, but let's say if we're sticking to a 5 minute execution here, we're looking for the same rules. We have this high, taps into POI. We don't take the first trade. Price gives a reaction. Looks like it gave a change of character already, but remember that we need more rules, right? So this low made this high, breaks structure here. Internally takes this low, change of character, but we still want to see more. We can't just enter off of nothing. So we see this get liquidated. Now price comes into our refined 5 minute point of interest, which is way more important than the overall 15 minute. If we were trading the 15 minute, we'd want to see a 15 minute change of character. And this is much better as we have a refined level. So liquidation, mitigation, price comes into this demand that made this new high. This is a strong demand, strong point of structure, gives a reaction. This doesn't really create a good flip necessarily. We don't really, maybe we do sweep some liquidity in here, but we still tap into these levels. So nothing that I'm too clean about. And then we break structure. Liquidation, mitigation. We don't have an aggressive reaction necessarily here, but we do break structure, get a change of character. There's no flip, but what do we have? This is the extreme. So technically, this, whatever this is, doesn't matter, but we have this extreme doji candle. And this extreme, while it didn't necessarily do anything, this is the highest point before the break of structure. And like we said, the extreme is technically always valid, right? So in this case, we could have set this knowing that there was a range here and price could come back in to sweep these levels because we have this high, and this high. So this is liquidity even further for us that we swept. Top. Price comes in, taps the 50% of the extreme right here, super clean. Entry at the 50%, right? Now you could take 25%. This is a doji candle. We'll take the, let's say the 50%, 4 pips stop loss, just cover the high just a little bit. What are we trading off of? We're trading off of a 15-minute point of interest. This low was where we got the pull back, the swing high to the swing low. We're expecting a pullback into what? Premium territory. This was the point of interest. Price tapped, gave our signal, liquidation, mitigation, change of character. We entered at the extreme. Price tapped, broke structure to the downside. Did it hit? let's see. Go back to that level. And it broke structure and hit take profit. 21 plus R, right? Hopefully these examples are making sense to you. I'm just trying to really go into the basics of these entries here. So let's look at what time frame could our could that point of structure be? It looks like it's here. There it is. Okay, so let's delete this thing here. So this is another one. So remember, we're looking. What direction are we doing? Are we bullish trending or bearish trending? Here, when we get this break of structure to the downside, this low that makes this high, that respects this high. Price pushes down, fails to make a new low. We get a pullback. Technically, that means the high is weak, but we could just be pulling back to better pricing. Price comes in, forms an extreme, breaks structure. This is a big, massive swing to the downside. So let's look at the premium. If we looked at 50%, we'd have a lot of POIs. I see a lot of stuff in here that we could focus on. So we're using above 70%. This is now premium territory. Marking out our POIs on the 4-hour. Here's what we can see. We have a lot of stuff we can look at. Now remember, I'm trading in this case a lot of times confirmations. If I'm setting like limit orders, like risk entries, then you'd be taking a lot more risk, because let's say if we set a limit at all three of these, right? If we set a limit at all three of them, we would probably take this as a loss. This one worked out. This one didn't get triggered. So one loss, one win, not bad at all. But if let's say these two get taken out and the extreme holds, 2 losses, 1 win, not bad if the RR is good, right? But that's why confirmation entries are pretty cool and they're important, right? So here, what do we have? First of all, I love this extreme considering it swept, right? And then it pushed to the downside, and this one directly broke structure. So this extreme is strong. It swept liquidity to the left, equal highs. It immediately pushed down and gave us a change of character. This wick pierced this level. We just have very aggressive sells, right? So this is extremely valid to me, right? If price has enough volume to push to this extreme, I want it. I'm setting a limit on it, right? Now, preferably to a refined level, but I could set a limit on this and be comfortable. Now, what else do we have? Price makes this low, so this high to this low. We get a pullback, and then we break structure, right? We have this high to this low, right? In there, what do we have? We have this area that's a sweep, right? If we drag this out to the right, and now we focus on this area here, we have this demand, price taps. Well, actually, price pierced it, so it's not really that valid here. But if we take this demand here now, right, this low, no matter what happened, right, this low to this high, pull back, we tap. Maybe this is a flip, right? This technically is a flip. We give a reaction. Or actually, I'm sorry, if we look really closely, we can see that it's a no man's land, I think. Look to the left, nothing, because technically this is the demand right here. So no sweep, but no flip. That's still valid, right? On a lower time frame, that probably looks, considering it's a wick, it probably looks like this. And so to me, that's a valid entry. Decisional, and it broke structure to the downside, took out this low. This initial pierce just gave change of character but didn't break. The actual break of this strong low that made this strong high, or that high, actually was broken when we got candle body closure. So technically this is a strong sweep, but not a flip. Price comes down, gives a reaction to this demand, which pushed price higher, respected this level, pulled back. So this is a demand, price taps, ranges a little bit, create a little base here, and then break structure downside. No sweep in this case from the POI. So now what are we doing? We are awaiting for price to come into our area and seeing if we get a confirmation or a reaction. Did I refine to the point of interest? I did. So I guess in this case, let's say for this first POI, price is coming up, doesn't tap it, we get a reaction pulling back down, continuation. We get no pause in this POI, so we completely run it, right? We're coming in, and once we take out this level, not important anymore. Also didn't give us a sweep. So we're focused more on these two POIs. maybe we could refine this 4-hour sweep, right? So let's look at what the 4-hour looks like a little bit more in depth here. Let's see. This sweep is valid as it took some liquidity. We're on the 15-minute. This looks like a pivot, buy to sell engulfing. On a lower time frame, this is going to look probably like something like this, right? Because it's a pivot. But let's see. We can go to the refinement, and this is the 15-minute point of interest. So what do we have? So we have two things that we could consider. We have this area that's technically it flipped, but we did not have any sweep, right? But we do have some imbalance here. That's important, right? So we could consider this area. But the reason why this one looks more attractive is because technically we have a good imbalance in here too. And this is what? This is the actual sweep. So if we consider it like this, the price taps into this area, pushes to the upside, forms an extreme. On here, now we see that we swept some liquidity. Sweep. And so in this case, because this area is a reaction, this is the extreme, anytime that we get flip entries, we like to enter at the extreme that took liquidity. So technically, this was just a reaction before continuation to the downside. And this area is where we swept the extreme that's unmitigated. We left behind an imbalance. Did it do anything? Not necessarily. It didn't break anything relevant, right? But we do have imbalance. It is the extreme, and it's the extreme of a flip on a lower time frame. Now, sweep, no flip. If we go back to the 4-hour, where did I draw that off? Let me see. 1 second here. Yeah. On here, we don't see a flip because this didn't react. This pushed up and created this. This didn't react to anything. So technically, this isn't a flip on the 4-hour. But if we go to the 15-minute, let's see. Please be patient here. We're 2 hours in. I'm just as far in this as you are. All right, let's see. So where are we again here? So on here, we can actually see this. It's a lot more clean. We do tap into this. On here on the 15-minute, we do have a flip. So this is now a no flip on 4-hour. But we have a flip on 15-minute. And now we have a refined point of interest. So we have this level. And now we have the extreme. And so let's see. We'll go to the right. All the way to the right. I'm even going to drag this one. This one really wasn't relevant to us, but when the extreme was important, but we'll see what happens. That way you can kind of get an idea of, well, what if you had both, right? So, let's see. So here's what happens. Price goes through and completely liquidates the first POI. Sweeps it, no change of character. Change of character in this case would be required technically for the 15-minute would be down here. This was the last sell candle before we have this buy. If you wanted to be very aggressive, you could say this one would create a change of character. But we basically just ran through this POI, so nothing. Not valid for us anymore. This one we tapped, right? And then what do we have? We have some sort of reaction. Price isn't very aggressive in this area. In fact, we're just building liquidity here. It looks like we're kind of just really hanging out here, right? So I'm not seeing anything in here. I didn't see a liquidation. I saw mitigation. Have yet to get the change of character. Here we get change of character. I want to see some sort of break. Here if I look, technically this low created this high. I'd feel comfortable if the 15-minute low went as a reaction to that. If not, then I'd like to see some something that makes a little bit more sense. I'd like to see my liquidation first. Here is the setup. Here we have this high, we have this low. This looks pretty aggressive. In fact, once we see this, we're like, damn, maybe we missed our opportunity to get back in. But we can actually see a lot of liquidity. We see some liquidity in here, right? We also see liquidity here, right? This high here. And we know that we barely tapped this POI, and because this is a sweep, a flip, right? And this was the extreme candle on the 15-minute. We could get it maybe even a deeper mitigation. Let's see what we get, right? In fact, price pushes up higher. Boom, we make this high. What do we get? Immediate liquidation. So here we get a liquidation of this, all of this liquidity here, of this, all of these relatively equal highs, of this structural high. Price taps into the 15-minute once again, just a little bit higher, but we do get candle body closure up here, much higher. We know that this low made this high. And so for me, I have liquidation, mitigation of the 15-minute POI. Where do I get my change of character? Here. Now for here, remember, our change of character was pretty low in the leg. Realistically, it was this one. This was the true clean one. So in this case, this didn't really give me the change of character like I wanted. And so therefore, you know, I wouldn't have been able to get in with a clean entry here. But look at this one. This low makes this high, candle body closure. Price pushes down. Here we have a wick that pushes through. That still gives me a change of character, because for me, wicks do provide a change of character. Now what am I looking at? I can look at a couple things. I can look at the extreme, or I can look at some decisionals. I see this area here. This is basically, we have a lot of wicks in here. Maybe even some, we can even clarify this if we drop some time frames. Here we pull back up. This sweeps the candle prior, doesn't really do anything too much. We could say that the first sell candle here that mitigated, that swept the previous level. So here technically, let me draw this line so you can see where we got it from. That high, we draw this all the way across. Look at this, we have little 3 pins, so 1 pin, 2 pin, 3 pin. The middle one's the one that swept liquidity. And so this tapped into some resting orders, and as a result, this candle closed bearish. We didn't really get an aggressive reaction, but we did get a change of character. In this case, there's no decisional. The extreme is technically still valid. So in this case, you could do that, or you could also just take the entire range and enter at the 50%, and you'd still be pretty comfortable with that. In that case, we're going to get into this candle. There is the extreme, because there's no decisional really in here, and no decisional that looks too clean, right? This is still in the extreme territory, right? Price comes in, taps, entry at the extreme. Here's the 50%, 2 pip stop loss, just above the high a little bit, considering that we kind of just made a sweep anyway. So we're going to give a little bit of room for some spread. What are we targeting? This is a 15-minute, 4-hour zone, I think. So what do we have? Where's our weak territory here? And we could target a lot lower too. So this was a 4-hour point of interest, so we could target the 4-hour low all the way down there. But considering that, let's say we want to play it safe, we want to take 15-minute structure, technically this 15-minute low pushed into the POI, failed to break the POI. So technically that means that this high is technically going to, it means that this low is weak because it failed to break the high, failed, now supplies in control. Technically this is weak, as we had, this is where the pullback came from, right? And so we should target this level. Now technically you could also say that this one is another target, because this one did break some structure, but on the 15-minute it just wicked above. So in this case, I'd still like to focus on this one. And at the same time, you know, this trade would be 61R. But if we have a 4-hour target, because this was a 4-hour level, check this out. This was a 4-hour sweep, no flip on the 4-hour, but it was a 15-minute flip. We have now a 2 pip stop loss. a 4-hour change of character would occur here, so that'd be a safe place, right? But we also know that what? Our overall 4-hour target is down here. Because this low, this is a swing, right? The swing high to the swing low. Continuation is, if this is a pullback, it will respect the POI and break structure downside. Does that without taking us out. 210R trade, right? So that was all the examples that I've done for this video. Hopefully you understand on that. Now I have just a couple POIs that I've just marked up just for the sake of giving you more examples of POIs. These are going to be super quick because this video is already super duper long. My gosh, it's the longest video I've ever made. So let's see. Let me get rid of everything else that isn't for this, because that way there's no confusion. We're only going to focus on some random POIs just to give you the examples here. I think the 4-hour. Alright, 4-hour here. So this was one of the examples. Here we have this is a liquidity grab, liquidity POI, swept liquidity. That is the example of a 4-hour of what this looks like on the 4-hour, right? Mitigation at the 50%, that's a good entry. Now we have a 1-hour candle here that we can look at. This is about a 1-hour sponsored candle. Now I preferably like when the candle body is full bodied and has no wick, but it technically is still valid. It does sweep liquidity and it's full bodied. And this one does, like the model, get engulfed technically. This is another what looks like a sponsored candle, but because price is bearish, this shouldn't hold. It's counter trend, and that's why that one goes, right? We might get a reaction to it, but no, it's counter trend. So this is pro trend. Price comes in, taps the 50%, respects it, taps a little bit higher than that, but still doesn't take it out, right? That's an example. 15-minute, I have a couple little ones in here. This is a buy to sell engulfing, right? So the low of this candle broke as a result of this one. So decisional or extremes, and we have decisional of this leg, right? Here we have a buy to sell engulfing, the buying of the wick, buying up, and then this one is a sell candle that engulfs the previous candle, and then we continue to the downside, break structure. You can see that price came back into the buy to sell engulfing, broke structure to downside. Mitigation of this level, right? Now I know that I have 1-minute POIs in here. 1-minute POIs are super clean sometimes. So let me just show you this. I guess I probably didn't even complete it, but the idea behind this, whoops. There we go. Notice how we are stepping down the ladder as we break structure to the downside. Look at what we come to. In this case, we have this extreme, but here we have a decisional. This looks like a doji candle. It's respected, break structure to the downside. What did this tap into? Here this looks like maybe it was some sort of flip. Did we get a flip out of this one? Any sweeps or anything? Nothing super clean in here. This one actually looks like it tapped this candle here. So this was a buy to sell engulfing. Here we have a pause, break to the downside. This is where we actually got the decisional, put some volume and momentum in as we swept to the downside, but we left behind only a wick, right? So not the cleanest one. The price still comes into that POI. What do we have here on the 1-minute? We have a decisional, but we also have an extreme that's very clean. So did we do this? Nope, nothing. That one ran through. Here we have this extreme that didn't get tapped either. But can we do the range? So if we take this high to this, that's pretty close. Nothing too good here. So no entry here. We got nothing there, unless you traded at the open of that range, right? So just a couple ideas here, just trying to show you how you should look at price. The whole idea behind this is focus on well-priced POIs, right? look at the entire graph. This is going to be, once again, as a reminder, it's going to be linked in the description. Let me know if you have any questions at all. If you want to join my Discord, feel free to join. Remember, summary, extremes, which one is where did we break something strong from? Was the volume momentum sourced from the extreme or from the decisional? Make sure these rules are met, right? What does a candle body look like when we either are taking a risk entry or a confirmation entry? The POI should be some sort of, let's say, a variation of something like this, right? The other thing is change of character and flips. If you're taking confirmation entries, the market structure video goes a lot about this. Look for valid change of characters and flips. A valid flip is going to save you a lot of traps, save you from falling into a lot of traps, as without the flip, without the sweep, likely price will sweep you, right? Premium or discount territory, are you choosing the 50% or the 70-30? That's up to you. Setting your orders, are you focused on, is it better for you to take more trades or better priced trades? Completely up to you. Refinement before entry, make sure you ask yourself, is price bullish or bearish? Are we expecting continuation or pullback? What is the most recent swing that broke structure? Do we have a valid extreme or valid decisional? Are the POIs well priced and premium discount? And how far are we able to refine our POI? Can we do a 4 hour to the 15? Can the 15 go to the 1 minute? Can the 1 minute go to the 5 seconds? They should look some variation of this, maybe doji candle even, right? When do you enter? When the execution time frame shows on your time frame of execution. This is for confirmation entries. When you see a liquidation, which is a sweep of liquidity, a mitigation means respects the POI, you get some sort of reaction, you get a change of character, and high probability if you get the flip. Now, when you enter a 4 hour POI, you can look for, if you can get the 4 hour POI and you can't refine it, then wait for a 15-minute change of character inside the 4 hour POI and enter at the 15-minute extreme or flip, right? If you get a 15-minute POI, whether it's, if you refine the 15-minute from the 4 hour, you wait for a 1 minute change of character inside the 15-minute POI and enter at the 1 minute extreme or flip. That's what this one will help you for, right? For confirmation entries. So hopefully you enjoyed that video. I hope you have a wonderful trading week. Let me know if you have any questions, and I'll see you for the next video. Thanks for sticking through this one.